Hello, everyone, TechChill attendees, startuppers, investors, and whoever is joining over here. This is a Karma Academy, a session that's from Karma Venture side. We've been bringing to the market and to other audience for a couple of years now. And basically, this idea is very simple behind. During our existence of more than 5 years, we've been interacting with amazing people that have very deep insight about different topics. And Kyle over here is one of the first people that we brought into that context of Karma Academy. And I've known Kyle now for almost 4 years. And initial interaction we had with him was exactly about the topic that we have today. It's about pricing. It's about how do you present your product, how do you grow your business through that. And Kyle really has a deep expertise in that. I'll hand over to Kyle for you to do introduction about yourself, about your 10 years long career in this, and happy to hear more about the chat and the platform. Please ask your questions and post any topics you want to be more elaborated about to the chat section. I will monitor this and help to facilitate this discussion here. Kyle, over to you.
Awesome. Well, nice to meet everyone. I can't see you, so the chat is the only way to interact, and I would highly encourage you to ask away, and we can get to the questions or comments. As earlier mentioned, I'm an operating partner at OpenView. OpenView's VC that invests exclusively in B2B SaaS companies at the expansion stage. And so we're normally investing around Series A, Series B, Series C, and then we have a pretty large team that works with the portfolio companies around scaling, particularly around scaling their teams. We have 6 full-time recruiters that just hire for the portfolio and then attract more of the right customers for the business, and that's my team. And I started from Simon Kucher, which is the world's largest pricing consulting firm. Not super well known, but we worked with about a quarter of the Cloud 100 while I was there. And then since I've joined OpenView, I've probably worked with more than 20 of our portfolio companies around pricing and packaging. It's a topic that founders know they need help with, but there's not normally someone on their team who has done this before. It's not always the most urgent problem to solve. And so it doesn't get the attention and the research that many other parts of running a business do. So hopefully by the end of this talk, you'll know what are the most common mistakes that companies make and how to correct those to think about pricing the right way to grow revenue for your business. And just for if you ever want to get more insights, I publish pretty regularly thoughts around all things pricing and growth. You can follow me on LinkedIn or my Substack newsletter. And as we start, I initially gave a version of this talk that I called Mastering SaaS Pricing. And the feedback I kept hearing from folks was mastering SaaS pricing, like we are not there yet. We just want to fix our broken pricing. And many folks say, if they didn't pick pricing out of thin air, it was pretty close. It was maybe a whiteboarding session, a couple hours of discussion, and there wasn't a whole lot of research, data gathering, interviews, surveying to come up with the initial pricing. And it might have evolved since then, but companies typically don't take nearly the same kind of rigorous approach to pricing that they do to other parts of the business, whether it's managing the sales pipeline, demand gen campaigns and marketing spend, their engineering org, or anything else. And the challenge that creates is that most companies say that their pricing model doesn't actually align very well with the value that their product delivers. And you might think, okay, this is not that big of a deal. It's just pricing, right? How important could that be? The reality is that we don't talk about this very much in the startup community, but pricing is critical to the success of your business and getting to that next stage of growth. And data from first round capital shows that founders who struggle to raise capital are 3 times more likely to say they monetize too late, twice as likely to say they picked the wrong business model, and 40% more likely to say their burn rate was too high. And the consistent theme was they weren't closely thinking about product market price fit. And to me, there's a lot of conversation around finding product market fit and how that's sort of the holy grail at the seed stage and even Series A. But to me, you don't have product market fit if you don't have pricing power. And so I think of it as product market price fit. You're looking for a product that solves a pain point that's so acute that folks are willing to pay a fair price for it, and that you're able to capture enough revenue from it that you can build a large and enduring business. There's enough customers who are willing to pay enough that you can build that. And for many companies, the pricing needs to fit the go-to-market motion that they want to build. And so it's challenging to acquire customers, especially if you sell to large enterprises. And if you don't capture enough revenue from those customers, you can't put in the amount of investment you need from a marketing and sales standpoint to actually reach these folks. And so there can be a death spiral that even happens with a business if you don't approach pricing the right way. So hopefully, if nothing else you take away from this presentation, pricing should be top of mind at the CEO level, especially as you're at the seed stage. And there's never an easier time to change or test pricing than when you're at that stage. Because when you have a whole lot of existing customers, when the market understands how you already priced, when you have a sales team that is trained a certain way, it gets harder and harder to change over time.
I would ask over here, perhaps one question that you mentioned that, from the seed stage onwards, like the CEO should think about this, but is it even like, before seed stage, like when you're actually like, thinking and brainstorming about your business and what you want to found in a way, like should you already then actually think about this and study that field in a more scientific field?
Absolutely. Well, and I think most founders are pretty good about doing having discovery conversations with people in their market to say, hey, would they be interested in a solution like this? What pain points do they have? Like, is there a viable product here? And to me, pricing should be part of those discussions. So you can even ask, hey, what do you think would be a fair price for a product like this? And then start to better understand, what are their reference products? What else do they pay for? How challenging is it for them to get budget? What would they need to see in order to pay? And that way you can take the idea from validating it, hey, this is an interesting idea, to, oh, there's a real market need for this. And people would kind of get on a waiting list to buy this product if I were to create it, which is just a much better place to be building a business from. Mm-hmm. And actually, for folks that want to learn more about that, there's a great book called Monetizing Innovation by one of my first bosses, Madhavan Ramanujam. And the thesis is that you build the product around the price and the willingness to pay. And it's kind of a counterintuitive way of thinking about what products to build in the first place, but a great resource when you're thinking about what product opportunity to go after. And I touched on it a little bit, but I, for the last 10 plus years, have spent a lot of time working with SaaS startups on their pricing. So I have a survey of SaaS companies on how they approach pricing. We've surveyed over 1,000 folks so far, and some of that data will be included here. Recently published a usage-based pricing playbook about why more and more software companies are implementing usage or consumption-based pricing, and how that really changes a lot of aspects about building a business and not just pricing itself. But that is consistent with really dramatic growth, especially at scale, and healthy growth from your customers. And then published an ebook called Mastering SaaS Pricing. And so all of the insights from this work, and then from my direct experience working with our portfolio companies, will be covered here. So we'll walk through case studies and plenty of data for you. And then when I reflect on that work, these are the 5 pricing mistakes that I see over and over again. And if you could correct these, you'll unlock tremendous value for the business. And the first is that you pick the wrong value metric. So what is a value metric? It's also called a pricing metric. This is the unit that defines primarily how much a given customer pays or how much revenue you capture from the customer. Historically in SaaS, this has been seats, but some companies charge based on company size, employee count, certain usage metrics, storage and data, the ROI their customers see, transaction fees, all kinds of metrics. And the biggest question I'd ask you is that, are seats really the right metric for your business? And for a lot of companies, historically, this has been the default. I think when software moved from on-premise to SaaS, especially starting with Salesforce, this became the dominant way of selling. But I think the reality for most products is that the product doesn't get 2x as valuable when you double the number of people who have access to it. And in many cases, charging based on seats can make it really challenging to expand within a customer or to even become sticky in the first place, because not enough people in the organization are using the product and seeing the value to be able to advocate and grow the kind of number of use cases, grow the adoption over time. And so if you are selling a horizontal application, which is software that has a very broad applicability across companies and across even people at a company, so software like a Slack or a Salesforce or a Zoom, seats are still a pretty common metric, and they work for most of those companies. But if you're selling a vertical software to kind of a specific industry persona, or an infrastructure software where developers or IT teams are your primary audience, seats are becoming less and less common, and companies are having to get more creative around the value that their product delivers and increasingly think about more usage-based metrics. And I think on the infrastructure side, as AWS and many other services were pitching, hey, only pay for what you use. You don't have to make a huge commitment up front. You don't have to do all the work of figuring out who's going to need it. That helped companies say, hey, I want to pay this way for all of my products and not just AWS. And so really usage-based is becoming the predominant way of selling in these instances. And when you think about the value metric, many companies also think about what are your competitors doing? And I just want to copy what my competitors have from a pricing standpoint. But you can actually use the value metric to differentiate against competitors and generate more revenue in the process. And it's something that really needs to be thought through for your specific product and customer base. I wanted to share an example in the OpenView portfolio. It's something called VTS. They're a vertical software company selling to commercial real estate. You can think of them essentially as a CRM type of platform. And they've recently raised it over $1 billion valuation, so they're highly successful. We invested back in their Series B, and at that point, they charge on a per building basis. So that was super simple to explain and sell to customers. Just, hey, how many buildings do you want to bring on the platform? Oh, maybe we just test with 2, 3, 4 at a time, and then you can bring all of your portfolio on. So it's really simple, led to fast sales cycles, easy proof of concepts with customers. But the challenge was this left a lot of money on the table because they were charging the same price point for the Empire State Building to be on the platform as a 3-story suburban office building. So left money on the table with those big buildings, but then they also found their customers weren't bringing all their buildings on the platform. They'd bring their biggest, most important assets and then not the rest. And it was actually challenging because the software was better if you could manage this and have visibility across everything versus managing with software for some assets and manually for others and have multiple systems. So it created a kind of a workflow challenge for their customers, and pricing was not leading to the product behavior that they wanted to drive. So we reviewed a lot of different options and ended up charging on a per square footage basis, where it's based on how many square feet of real estate assets you want to manage to the platform. And this aligns very perfectly with customer value. They lease their buildings on a per square foot basis. So they know the price per square foot. They think that way. And they could still start with certain assets as a proof of concept and pay based on the square feet of those assets. But they could also really easily kind of scale VTS across their entire platform. After they rolled out this pricing, they were able to increase the number of square feet on the platform, didn't hurt conversion rate at all, but increased the price per square foot they were getting by 70% because they were now better aligning the price with the value their customers saw. It had a huge impact on the business.
Kyle, I would ask over here, like, the change that they made, when is the right time to make such a change? Like, how do you go to customers and explain that actually you want to change the whole business model that we had so far in the pricing logic?
Yeah, great question. So they made this change at Series B. It gets harder and harder the more you wait, especially when public companies try to make changes like this. It's really, really painful. They started with new customers as the initial point before migrating all of their existing customers over. And then with the existing customers, they started cherry picking accounts where they thought they had the biggest opportunity, where pricing was a barrier for these customers to roll out VTS across their entire platform. And by doing so, they could potentially save money versus the old pricing scheme. So they started with, I guess, the new customers to see what the market reaction would be, what the conversion rate would be, if customers would buy this way. The most successful, or the most highest opportunity, was kind of highest odds of success, existing customers. And then later on, only after collecting that data, did they go back at renewal to their legacy customers. And in those cases, they were thoughtful. And I think that you always want to be mindful where maybe you give multiple options for the customer. Maybe you change their pricing model, but keep their price point the same so that they're on this new way of buying, but it's not creating as much friction to migrate them. There's a lot of different ways that you can make this go over more smoothly from a customer standpoint.
Did you have any examples like how it has gone wrong in a way, that what definitely not to do if you're about to change the model?
What not to do? Well, I think the most public example of a company that's pricing change went wrong was Zendesk. This was maybe even almost 10 years ago. They announced pretty dramatic pricing changes on existing customers as well as new customers. And it was pretty big price increases in a lot of cases. And I think that they were not ready for all of the pushback and the kind of the challenges this created, especially selling to SMB customers, making them feel blindsided, like this was coming out of nowhere. It just was really challenging for their customer base. And they ultimately had to walk back and say, hey, we're not gonna kind of do this anymore. Like, our bad. It'll only apply to new customers. And so I'd say just make sure that you take the right steps where you're mitigating risk and you're getting learnings from each incremental step in that process. Ideally, these pricing changes are kind of a non-event with your customers, and you're not getting a whole lot of like bad press or backlash. Like, it's just kind of normal part of doing business.
Mm-hmm.
And then there's a question in here about the risks of tailored pricing with different customers, and is price discrimination applicable in B2B? I don't necessarily call it price discrimination. I think of it as price differentiation. So where you're pricing based on the value that your customers see. And there's a lot of ways to do that. And so even, seat-based pricing is a form of price differentiation, because you're charging your larger customers that need more seats more than your smaller customers that buy fewer seats. And there's a lot of different ways you can think about that. With a usage-based pricing model, the price differentiation approach is based on who are your power users, especially of certain features or in certain usage metrics, compared to your kind of less kind of heavy users of the product. There's a lot of other ways you can think about it too. Some companies have different pricing based on the geo that they sell into, based on the industry. They'll have different discounting guidelines for sales based on the competitive situation. There is actually a lot of pricing differentiation in B2B, and I'm not a lawyer, but there's not normally the same kind of concerns around price differentiation in B2B as B2C, especially as long as it's justifiable. And in most cases, there's not a whole lot of transparency around pricing. And so your customers, especially your enterprise customers, don't necessarily know what others have paid. And they understand that others might have paid a different price, but they also might get a different level of service, a different amount of features for a different number of users. Like, there's a lot of factors that could go into it, and people understand that. All right. Then pricing mistake number 2 is that you make it hard to buy. And I want to talk about a trend that we've been picking up on at OpenView around how software buying has evolved. And so when you go back to the 90s, the era of on-prem, it was all about data compatibility, selling to the CIO, going out on the golf course and making these large 6-7 figure upfront deals, and then kind of handing off and saying, all right, we've implemented, maybe we'll pay us an annual maintenance contract, but software is yours now. see you in another 5 years. Then we started moving to an era of cloud-based software selling recurring annual purchases on a subscription basis. And this data compatibility and on-premise installation was no longer as much of a concern. And folks were able to reach into business line executives like the VP of marketing or VP of sales and sell really targeted solutions for those business-specific pain points. And today we're actually seeing this shift go even further down to the end user level, where there's an expectation that end users are discovering products, whether that's Slack, Dropbox, Zoom, Datadog, Twilio, you name it. They're trying them out, and then they're convincing their boss what to buy. And there's an expectation of pricing should now be pretty frictionless for getting started. People expect to start for free, pay later as their usage grows or as they're seeing value, and as they want to go from that end user to team to organization-wide use case. And increasingly, distribution is happening with product-led growth, where the first interaction a customer has is in the product itself rather than with a sales rep. And so that really changes the pricing dynamic, where you have to be really as easy to buy and frictionless as possible in that initial interaction.
Does this same logic also apply for enterprise deals, or is it more like Slack type of platforms?
So I'd say it still applies for getting folks started. And so there's many companies that sell to enterprises that have free plans and kind of purchasing, self-service purchasing capabilities for an initial purchase. And then there's more complexity once those people are seeing value and you want to take that product to a larger scale. So you might think about like SimilarWeb, which released their S1 less than a month ago. Their average deal size is like $100,000. They sell to the enterprise, but they have a really generous free product where people can get started. And that free product turns into a whole set of really product qualified leads that sales can go sell large deals into. And when you look at ServiceNow, they've been investing around product-led growth. Don't get much more enterprise than ServiceNow. Nutanix has as well. OutSystems, there's many examples of people starting to apply this into enterprise environments to start to really attract more folks, make themselves essentially part of the whole buyer journey. If you think about an enterprise purchase, this is just an aside, it might take months and months and months and a lot of research online before someone ever wants to talk to sales. And your product could either be part of that buyer journey and engagement and create stickiness and a more qualified customer, or a competitor could be in that position. And once a user has started trying out a free product, adapting it to their workflow, they're seeing value in it, they might not even start talking to competitors because there's a perceived higher risk. And if something's already working, let's just keep going with it. And so I think that this is moving more and more to the enterprise. COVID accelerated that last year, but it's not going away.
Mm-hmm.
And so on the Slack note, I think that their strategy is super interesting. When you think about their product as an end user, you can just get started with Slack for free. And for many companies, they think about Slack's pricing, their free plan is extremely generous, so generous that most SaaS companies would be afraid of going anywhere near that with their free offering. You can use their free plan for an unlimited number of users. It's really generous in terms of what product capabilities you have access to. And so for an end user, you start bringing on your team. Slack would be really boring if it's just you using it. And then all of a sudden, Slack goes from this place where you're kind of having one-off conversations with your teammates to this place where really important work and data is happening. And it's at that point that they have their paywall. They have their message kind of history limit that goes away, and you can't search or get access to the data beyond the most recent information. And so once Slack goes from this place that's a nice to have chat tool to really mission critical business communication tool, that's when they charge. And it's a really, really effective paywall. And so to me, the mentality should be deliver value to that user before capturing that value. But there can be a really kind of firm line in the sand this compelling event that you create to make that happen. And then to Marilee's point, this isn't just Slack and Zoom. And so in 2020, dozens of companies launched free plans. And we even started seeing that accelerate even after some of the lockdowns were lifting. So GoDaddy, which was founded in the 1990s and has never had freemium products before, known for web hosting, $700 million software business. They started testing freemium as a small scale experiment in spring of 2020. They saw that it brought millions of new signups and higher than expected conversion. And so they started exposing it to 100% of US traffic by the end of last year, and now rolling it out into international markets. ZipWhip in our portfolio is a business texting tool. They actually text enable any landline phone number. They announced a pretty big deal with Twilio just yesterday. And they introduced a free trial and self-service purchasing in spring 2020. And this allowed them to triple the number of new customers they add every day without hurting their average selling price. And then JFrog, which is a developer product that sells mostly to the enterprise with a pretty large average deal size, they launched a free offering in September of last year. And this drove thousands of new registrations. And the key thing they were looking at is free users entering the sales pipeline for enterprise deals. And that is really clear that it's happening. And so I'd say this is not just for the companies that you expect. Even enterprise-focused companies are moving in this direction. And then the question that comes up a lot is, okay, should I go freemium or free trial? There's pros and cons with both. The data shows, and this is from OpenView's product benchmarks, that freemium leads to more signups from website visitor to sign up on your website. There's about a 6% conversion from unique visitor excluding customer to free sign up versus 45 on a free trial on average. But there's lower conversion from free to paid typically in a freemium business. And so if your product gets more valuable over time for a user, or a free user ends up leading to more free users, right? Where there's referrals, word of mouth, virality, where like your free users really help create more acquisition overall, freemium is a better strategy. But if you're really interested in quick revenue, driving conversions from these visitors, and you're paying for a lot of your customer acquisition, free trial might be a better strategy. And then one other thing I'd just call out is you don't necessarily need to choose, and many of the best companies are doing both, where they start people on a free trial, and then at the end of 7 days or 14 days, they downgrade you to the free plan. And this is the benefit of really being the best of both worlds, having great conversion and being able to bring in more new users. And two really good examples of this are Airtable and Calendly, which has been super successful for them. And then one final one I'd comment on is a company called Logical. So they're a legal tech company in OpenView's portfolio. They sell e-discovery software, which is historically something that's been expensive, outsourced to vendors who did this on a services basis. And so not something that you expect to be adapting product-led growth. And they started out actually themselves as a services business. They pivoted to software as a service, and they kind of sold the traditional SaaS way. So $20,000, $30,000, $50,000 annual contracts, paid up front. And that worked pretty well initially, but you could tell their customers were kind of flatlining. It wasn't aligning with how a lot of their customers wanted to buy. And the challenge for a law firm is, you don't want to make a big upfront expense. You would prefer to be able to bill back these expenses back to your clients. You don't necessarily know at the beginning of the year how much you're going to use. And you might already have some kind of existing workflow or processes in place. But if you're an individual lawyer that just has an occasional e-discovery product need, and they want something that's easy to use, they don't really have that option. They have to go with either what's this corporate mandate or outsourcing it. And so Logical said, okay, we're going to introduce a pay-as-you-go offering where people can just pay on a per matter basis, so one-off, and then scale that over time as they need more and more. And you can see here, once they went GA with the offering, it really took off. They saw hockey stick growth. They signed up more customers in a matter of 3 months than they had over 5 years beforehand. And this really continued to scale. And it's because they were selling to customers the way their customers wanted to buy.
I would perhaps quickly ask over here that this pay as you go is not always the preferred model for some investors that actually value that, the customer is more locked in, like with some recurring business model. How would you comment that?
Yeah, most investors are changing their tune on that, I think. And so I'd say if your pay-as-you-go business has a net dollar retention of above 100%, where overall people tend to expand their usage and how much they pay you over time, even though there might be some churn from people using it as a one-off product. If net retention is above 100%, people treat it as recurring revenue. If net retention does not look like that, people treat it as like one-off services revenue. So think about it as a great opportunity for these recurring sticky products or products that someone might want to use once. And then once they use it once, they're going to use it twice, 3 times, 4 times, 5 times, and it really kind of scales on itself. And then from a public market standpoint, companies with more of a usage or consumption element to their pricing, more of a pay-as-you-go model, are trading at a 50% revenue multiple premium over their peers. And so I think that this notion that investors don't value usage-based revenue is increasingly getting turned on its head. And I think for a lot of investors, it shows there's no shelfware in your product. You're not hiding anything. There's not customers that have overpaid and are going to churn at the end of the year. And you're building a really customer-centric business model that is focused on driving more adoption from your customers. And so the companies that end up going with a usage-based model just tend to be companies that have a better long-term prospect. So those are my 2 cents on the topic.
Yeah, thanks.
And it looks like there's another question here. I've seen a few B2C products going the route where the price is adjusted to the average income in specific geographic areas. Should B2B solutions do more of that as well? It's a good question. It certainly does come up in the B2C world. Most B2B companies aren't that sophisticated with price differentiation. I think that there's some incremental value that you can get out of going that route. But my thought process is that that's probably not the most important and like best bang for your buck item to focus on, especially if you're seed or Series A. I would wait until Series C, Series D, Series E before you really go after that opportunity. The biggest ticket items are going to be the value metric, the overall price point, the packages you offer. Those are going to move the needle a lot more for your business versus adapting the price based on geo. And so the third mistake is that your upsell path is broken. And so we used to talk in software about the goal being 100% net dollar retention. And when I've looked at companies that have gone public in the last 3 years, 120% is the new average. And there's even companies like Snowflake that are at close to 160% range, where for every $100 they get from a cohort of customers, that turns into 160 at the end of the year. It continues to compound thereafter. And when you think about how to do this, pricing plays a pretty big role. And 2 of the most important ways to do it are feature packaging and usage-based pricing models. So on the feature packaging side, there are 5 different types of feature packages that companies follow, everywhere from really simple all-in-one package with everything included, clearly not a whole lot of expansion revenue here because you're just selling one thing, to super modular, build your own packaging where it really is scalable and you can sell a lot more to a customer over time. Where most companies net out, and I think there's a good reason for it, is good, better, best models where there's 3 or 4 offerings and you're able to show increasing features and increasing price points as customers go from maybe less sophisticated users or new prospects to more sophisticated, larger customers. Just really simple to communicate. It presents an upsell path, allows you to monetize new features that you're building to go after these more sophisticated customers. And standpoint tends to be don't reinvent the wheel. This works pretty well for most companies. You might be in a slightly different situation, but I think there's a good reason why 70% of companies have gone in this direction. And then I think even more importantly, when we look at these companies that have IPO'd, 7 of the 9 with the best net retention all have usage-based pricing, and 6 of the top 7 do. And so usage-based pricing is really important to having this expansion path in your customer base. I want to share an example. This is just an older example, but a well-known company of HubSpot. And so when they started out, they had good, better, best packages. They even called them small, medium, and large. There were a certain number of users and features that kind of increased as you went from one package to the next. But they were pretty big jumps in price, especially for a small business audience. And this made it challenging for them to actually expand their customers because there was such a big price difference between plans. They saw very high churn, especially from these smaller customers, and they had no way of monetizing customers as they were successful with the product. After a lot of debate and discussion, they launched contact-based pricing, where customers pay more as they generate more marketing contacts. So essentially, as HubSpot helps them grow the amount of leads and then create more revenue for their business, HubSpot will naturally take a kind of a share of that improvement. And once they rolled out this change, they were able to increase their net retention from 75% to 100% because they now had this really natural organic upsell path within their product. And so they didn't go completely down the path of usage-based pricing. They still have initial subscription tiers, and you pay for the usage on top of those tiers. But this is just a great example to show the power of incorporating a usage element into your business model. All right, I know we don't have a ton of time left, but I'll quickly go through two more of these mistakes. So mistake number 4 is that you're too cheap, and specifically thinking about for the enterprise. So once you go from that individual user or team to, okay, you're now navigating procurement and legal and finance, and there's budget approvals involved. Enterprise buyers are really not that price sensitive. They care a lot more about risk, reputation, failed projects, the cost of internally of making a change and training their team on it. But generally, they're not buying based on price. And you can use that to your advantage. And I think most SaaS companies, as they both become more confident in selling to the enterprise and improve their features, they also just realize, hey, we can raise our price and generally good things will happen. And so the typical price evolution, this is from data from over 1,000 companies. From seed stage up to IPO stage, companies have more than doubled their price, almost tripled it. And there's the biggest jump from seed to expansion stage, essentially from seed to Series A, and then again from expansion to growth stage, so more from like Series C to Series D type of stage. And if you are not adjusting your price and really testing price as this growth lever, you'll probably be left behind because you're missing out on a lot of potential revenue upside.
Kyle, I would ask over here that what does it say if your enterprise customer appears to be price sensitive, that is either about to churn or is not really flexible to actually, to be open for price discussions?
Yeah, my take is that there's probably a product gap there, or there's something behind the scenes about their business where they're going through a challenging time. And I think if you unpack it enough, it's probably not a price issue. It's probably something else. And so I'd really dig into what they're saying and why. And it's important as a business to be able to quantify the value and be able to kind of educate your customers, including their bosses, in many cases around what your product has delivered for their organization. And so I think of a lot of it, it's either something going on behind the scenes that you're not aware of that's not specifically related to price, or it's that you haven't communicated the value proposition appropriately. And then, so when I've worked with companies, it's pretty consistent actually that the pricing changes that companies make ends up having a pretty dramatic impact on their business. So, and this comes through when we survey companies as well. So when we survey companies about those who've changed their pricing in the last year, and when people change their pricing, it's mostly to increase prices, almost always. Only 2% who did that said that it hurt their ARR. And so 98% said it grew their ARR, and the most common response is a 10 to 24% increase in their growth rate. But many companies saw even better results than that. So I challenge you to think about how many areas you have, how many levers you have at your disposal where you could grow revenue by 25%. You don't need more headcount to do that. You're improving your gross margin when you do it. You're reducing your cost of acquisition, or the CAC payback at least, because you're able to pay off the customer acquisition costs faster. There's really not a better lever that you can find in most businesses than thinking about pricing. And then we talked about this a little bit, but these are some tips for how to do this without losing customers. And we've talked about this, so I won't take too much into it. But one thing I just advocate for is that communicating why you're raising prices. So timing it when you have a big feature release or product release tends to be a good idea, where you can show that you're increasing value for your customers. And then using it as a marketing tactic. So I like to create urgency. If you have deals outstanding in the funnel, you can give them 14 days, 30 days, where you'll honor the old pricing. Otherwise, they have to move to the new pricing. That's a great way of pulling forward deals and not having to discount those deals. And so there can be actually a lot of hidden growth opportunities that a pricing change brings forth. The other thing is, if you're changing pricing on your customers, that's a kind of tried and true way of getting them on the phone to talk to you. And so there are many cases where companies have told me, hey, we actually had our best quarter ever from an expansion standpoint. And part of that is when we were reaching out to customers about the pricing change, that was actually opening up a lot of other opportunities around how that company wanted to scale their product adoption. And so it kind of forces you to have some of those conversations and unearth opportunities that you probably didn't even realize. And then the final thing that I'll leave you with is that your pricing is static rather than dynamic. So your company will evolve pretty dramatically from the seed stage, where you have a single product, really relatively simple pricing, to expansion stage, where the product gets a lot more complicated. You have more tiers, add-ons. Growth stage, where there's maybe multi-product, you're going after different segments of the market. You have a big team, and so price execution and consistency across the team becomes a challenge. To later stage, where it's more about kind of churn mitigation, international pricing opportunities, where you're doing more differentiation market by market, and really kind of fine-tuning your pricing. You need to make sure that you're adapting price as your company is evolving. But most people aren't taking it seriously. So most companies have not done any sort of pricing research or any price testing. And in my opinion, the research is a great no-brainer. You could do this as either one-on-one conversations with customers that you don't frame necessarily as pricing conversations, but you can ask pricing questions in those, or price testing, where you're piloting new pricing with new customers. Maybe you have a couple of reps who get access to the new pricing, so you can see what the response is like. It's not true A/B testing in most cases. That really de-risks any pricing change and builds a lot of confidence internally for rolling it out. And when you do that research, you get great kind of nuggets of insight, like this was from a VTS customer with a very large building portfolio. They said the price is not material enough to be a factor in the decision. It's not even a blip on the radar. That helped give them confidence about moving to this per square footage pricing. And you need someone to own this work. So while ultimately the CEO will probably be the decider at the end of the day, you want someone that can own the pricing research and price testing, and can kind of coordinate all the different functions that need to be involved. But at 55% of SaaS companies, no one owns pricing. And then in most cases, it's just a piece of someone's responsibility, if there is someone. And you don't typically have a dedicated resource until you reach about 50 million in annual recurring revenue. And there's a lot of pros and cons with different people. I'd say who owns pricing is less important than having someone own pricing, and making sure it's a cross-functional process where you have a working group that can review the data, share their perspectives, and get aligned. And so just in wrapping up, these are the takeaways. So focus on the value metric first and foremost, sell to customers the way they buy, which normally means making it easy for end users to get into the product, to try it out. Making sure pricing creates an upsell path with usage-based pricing and feature packaging. And then as you upsell customers, realizing the enterprise buyer is really different from this end user, and you don't want to be too cheap for them. And then all of this, while these are best practices, at the end of the day, you'd want to experiment and iterate on pricing that's specific for your business. And so you need to make sure that you have people and the right process in place to do that. So that's all on my end. I think we might be able to take one or two more questions if folks have any, but hope folks took something away here, and we'll now be thinking more about pricing.
Thank you, Kyle. Please feel free to post your questions. Meanwhile, I used the opportunity to, of course, ask a few of the questions that we've seen like across our portfolio, that if you actually change the pricing, or even like more, let's say, radical way, even like business model, for example, from like outbound sales model, you actually switch to freemium and you hope to get leads in that kind of convert themselves. How much time should you actually give to those tests once you actually conclude that this approach didn't work and I should try something new or something different?
Yeah, it's a great question. It will depend on the sales cycles, right? And in many cases, I'm looking for like, what's the minimum viable test that will give me conviction around the opportunity. And so with freemium or free trials, one of the things you might want to do is take deals that were in the pipeline but didn't convert in the past, offer them as a promotion, a free product opportunity, see what the uptake is. And that's a group that's going to be hard to reach. They're not in this buying cycle anymore, but is there really a response where people are raising their hand, taking you up on that, and turning that into opportunities? So you can get some leading indicators within maybe a couple months. You might also start to do an ad campaign where you can advertise a free offering through some of your paid marketing, see what the uptake is like. What's the click-through rate on your ads that have the free offering mentioned versus a contact sales offering? And that just helps you understand, is there real demand for this, and is this attracting the right person? And knowing that you won't have, it's really challenging and time consuming to get like perfect data around pricing decisions. It might take a year before you know what the true conversion looks like, what's the net retention of the cohorts that kind of joined under one model versus another. But you can start getting signals of, hey, this seems to be pretty clearly working, or it's not. And with pricing changes, what's nice, unlike some other changes, is that the signals are pretty clear normally. Like it's either pretty noticeably working, or if it's not, then like that'll be pretty apparent, I think, within a limited amount of time. And so companies don't necessarily need to wait until they hit statistical significance. And I think it's better than many other changes that people are thinking about for their business.
Thank you. Our time is up. One last question from my side, that you're a true advocate for product-led growth, and already years back you were actually talking about this. Are we at this, like the starting point of this wave of product-led growth, like kind of leading the market, or is there already something new coming along? And if so, then what is it?
Yeah, well, it's funny. So OpenView coined the term product-led growth 5 years ago, and back then it was not something. It was really challenging to get folks to kind of wrap their head around it and understand it, think about how this is relevant for the business. And then fast forward to now, and it seems like every company needs a product-led growth strategy. There's hundreds of job postings looking specifically for PLG expertise. So it's really cool to see that that trend. I'd say companies are, I think product-led growth is still a trend, but what we're noticing is that many companies have adopted it at a surface level. So it's maybe a side initiative, like they hire a product manager to do product-led growth, but they're not really transforming their business around it. And so I think that the next trend will be taking some of these early experiments and successes that companies have seen and doubling down on them to really kind of more fundamentally transform how they operate.
Mm-hmm. Okay, thank you. Very, very insightful, and a lot to actually learn probably for every company, and also as an investor, that the way we interact and what type of brainstorming input do we give to our company. So Kai, thank you again, and it was a really good session. So, and hope to see you around in some physical world soon.
Yeah, absolutely. Likewise. Well, thanks everyone, and hope you enjoy the session and enjoy the rest of TechChill.
Yeah, thank you. Bye.